Good morning. This is Japanese Economic Review Channel. Today, we'll discuss the global market outlook for the final week of July 2026. As domestic earnings season kicks into high gear, we face significant macroeconomic uncertainties, including overlapping central bank meetings in the US and Japan and rising geopolitical risks. Let's dive in. This week is defined by three major themes: escalating geopolitical tensions in the Middle East, sustainability concerns over the AI bubble, and central bank divergence. With the BOJ and FOMC meetings aligning, investors should maintain a tactical posture with strategic cash reserves to mitigate sudden shock drop risks. Markets enter the week under heavy pressure. The Nikkei 225 dropped sharply to the 64,600 level, while the USD JPY sits at a 40-year low zone around 163.84. This heightened volatility reflects growing investor anxiety over Middle East stability and AI investment sustainability. Geopolitical risks are rapidly escalating. US-Iran peace talks have stalled, and Houthi blockades in the Bab el-Mandeb Strait have disrupted alternative oil routes. This has driven a sudden surge in crude oil prices, threatening an inflationary resurgence that could complicate central bank rate cuts and pressure equities. AI investment faces a critical test. Alphabet's staggering $205 billion capex plan for 2026 has sparked fears of funding burdens and large-scale equity raises. However, frontline analysts maintain strong upgrades for major semiconductor names. The upcoming Q2 earnings will test if long-term demand justifies short-term costs. We face a super central bank week. New Fed Chair Warsh's hawkish stance poses a severe risk of triggering a sudden risk-off equity sell-off if he hints at further hikes. Meanwhile, BOJ Governor Ueda shows flexibility on accelerating rate hikes, making forward guidance crucial even if rates are held. The USD JPY is experiencing intense volatility, trading in the 162 to 165 range. Upward pressure stems from rising oil prices and safe haven dollar buying. Conversely, BOJ rate hike signals and the hidden risk of unannounced currency intervention by the Ministry of Finance create a firm ceiling at 165. For Japanese equities, a smooth transition into an earnings-driven phase could push the Nikkei towards 70,000. However, if macroeconomic fears materialize, such as a hawkish FOMC or an oil price spike, a broad risk-off liquidation is likely. Thus, our strategic mandate is clear. Cash is king. Looking at the timeline, the midweek window from Wednesday to Friday is the maximum volatility zone. The FOMC rate decision and Warsh's press conference on Wednesday are immediately followed by the BOJ decision on Friday. Investors must brace for rapid market movements during these crucial 72 hours. Tech earnings will dictate market direction. We must closely scrutinize the capex outlooks of hyperscalers like Microsoft, Meta, Amazon, and Apple against their immediate margins. For enablers like Tokyo Electron and Advantest, we will verify if frontline analyst conviction in sustained compute demand holds true. Beyond tech, we monitor global demand proxies like Hitachi, Komatsu, and Boeing. Financials and consumer bellwethers, including Nomura, Mizuho, and Visa, will serve as crucial health proxies for the broader economy. Strong corporate results here could overshadow the current macroeconomic noise. To conclude, insulate your portfolio with elevated cash reserves to deploy during unwarranted shock drops. Carefully monitor the 165 FX ceiling for hidden intervention risks. Finally, look past the short-term AI noise and use this week's earnings to validate long-term infrastructure demand. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.